Good afternoon, everyone. We've got quite a few people joining today, so I might just skip it 5 or maybe 15 seconds just for things to start dropping in, and we'll kick off really shortly. Thanks for everyone being on time. Okay, so welcome everyone. Chances are, if you're dialing into this, you know Finura, and you may have met me at some point. So welcome to 2026. This has become a little bit of a tradition now. We've done this for about 4 or 5 years at Finura, doing our wealth tech predictions, and it's always a great way for us to start the year when we have a bit of clear air. It doesn't last very long, to think about what's ahead and obviously reflect a little bit on what happened in the year before. Tech's a really noisy world. It's so noisy, in fact, that a lot of our team need a break from it. So I certainly enjoyed a summer completely unplugging from AI and just getting familiar with my brain again, which is great. Just a bit of housekeeping. So everyone's registered will get a copy of the report that we issued. There'll also be a podcast coming out in a couple of weeks as well that Danny and I are recording, or probably next week actually, I should say, discussing some of these things at more length. We won't be taking questions today. I have 96 slides and 60 minutes. But if you want to talk about particular issues, please reach out to myself or the team, or drop us some comments on the social channels, and we'll answer your queries as we go. So, usual disclaimers: predictions are worthless, predicting is invaluable. So I encourage every business I work with to do this process. We spend so much time expecting things to happen, and I've always thought that the future is what you make it. So we don't always get it right, and often if we get it right too many times, we're probably playing it too safe. So I encourage the predictions process to be a big part of the business. We often ask our podcast guests to give us their predictions for the future, and the thing we love about predictions is it's a really human thing. It's not something that AI is terribly good at. Just some disclosures for myself. We're a growing business now, and so we had to change a couple of things about how we do it. So just a quick disclosure. So Hub24 is a shareholder in Finura's software business now. We announced that last year, but certainly not in the consulting business, which controls and does a lot of this predictions work. So just that quick disclosure. Some personal disclosures there for me. I am an independent director of a couple of advice businesses in the industry, which you can see there, and they're the direct shares that I own. So I don't own any personal stock in any of the companies in the wealth management sector as well. The other disclaimer: if I get emotional or something's kind of annoying me about some of these predictions, I may swear. So apologies in advance if profanity offends you, but anyone that knows me knows that occasionally these things slip out. Nature of being passionate about what you do. So let's get into it and see how we got on in 2025. So this is a review of last year's predictions. I'll talk you through some of the logic and probably some of the evidence we found to support did we get that prediction right, and then maybe some leading indicators to what we see happening in 2026. So advice tech remains in neutral gear. We really focus a lot, and we've been on about this for many years now, that our advice market is globally quite small, and often, despite the fact that we're small, we often have quite unrealistic expectations, I think, of, the technology industry that we work in ourselves. One of the things that's done us all enormous harm, maybe not all, but certainly service providers in the sector, is the reduction of advisor numbers. So many businesses that provide services to advice firms, their revenue models are hooked to advisor numbers. So whether you're a licensee, a service provider, or even a software company in particular, you've actually been quite negatively impacted by the drastic decline in advisor numbers in the industry. The people that probably haven't been impacted so much are certainly the platforms, and actually advice businesses, because you have less competition than ever before. I think the real challenge is obviously finding new talent. What I do want to say, for those that haven't heard us talk before, is that the addressable market, so the amount of money that's spent on financial advice or wealth management software in Australia, is incredibly low by global standards. And so for that reason, we need to calibrate our expectations of what we reasonably expect to get in the future in industry-specific software. That said, with the way the world's changing with software, we will actually find that a lot of other software solutions that we may have used for other things and will be becoming more specific for financial advice in the future. And I think that's a really great trend as well. I don't have any predictions on advisor numbers, but I'm just assuming they're going to stay at around 15,000 for the foreseeable future. AI awareness went off the charts. So we underestimated, hand on heart, just how big AI would be from a business perspective last year. It's become a really fast part of our business is consulting and AI services. Poor Danny needed a break from AI last year. She was so overwhelmed with it all. But, AI broke every norm we would reasonably expect for software adoption in our sector. Normally, advice firms are pretty slow to adopt new bits of tech, but when it came to things like AI file noting, you all ran in really, really quickly. We now see 86% of advice businesses are now using some form of AI tool. I think the other thing too was that the low barriers, or it was just rammed down our throat. Didn't matter whether you were a Microsoft user or a Salesforce user or a Google user, you sort of had an AI feature thrown at you pretty quick smart, and that's certainly changed the paradigm we feel in terms of how we interact with our software at the moment. Yes, it is the new .com. So, I know from our software business, we lots of approaches in the last 18 months about what's our plan with AI. Would be interested in building some AI specific software. I'm pretty sure if we put Finura.ai on our business, in our software business, we probably would have a sky high valuation because there is a bit of a hype cycle playing out at the moment. Very common, very expected. I'm not necessarily negative about it. I think new venture money into the software industry is a great thing. But what we are finding is probably some strange buying behaviours, which are really orientated towards AI that could be just a little bit short term in nature that we're seeing as well. AI apps came everywhere. So whilst AI sort of broad advice industry software stayed pretty neutral and there wasn't a lot of innovation we found in the last 12 months, we saw a lot of new players in the AI space. Whilst they are certainly industry specific, AI tools. So they do AI file noting for financial advisors, and some are looking to some other things, which I'll talk about today as well. There was a rush of them, both onshore and offshore. We've seen that in all the other markets as well. UK in particular has gone crazy on AI file noting in particular, but naturally we feel this is just part of a cycle. Is there room for everyone? Don't know yet, but there are some issues, potentially some challenges that some of those AI companies are going to face in the very near term. Platform monogamy, without question, probably our most contentious prediction that we made. And I'm not sure why, because this has been happening for a long time. So platform usage has been steadily declining, as in the number of platforms and advice business users for quite some period of time. Investment Trends do a great job tracking this data. So when we started the company 5 years ago, it was around 3.2 platforms. It's now dropped well under 2. Quite curious to see where it lands this year. Our data certainly says that it's shrinking, and there's some real reasons why that's happening. Obviously, businesses are finding that many of the platforms potentially are less differentiated. So they all tend to do similar things, and the rate cards are so competitive. Obviously, some of the leading platforms have done some really pretty impressive things in terms of building tech and capability that I think are garnering loyalty for their advisors and just making it easy for them to do business with it. And probably the final point, if I sort of wear my director hat on in the industry, working with advice firms, is that we are seeing evidence of advice firms being acquired at higher multiples when they use less platforms. So 2 common themes we find is if you use less tech, keep it simple, lean and mean business, and you all on one platform, nice, tidy managed account offer, we're still seeing very high revenue multiples for businesses that have been acquired in that space. So I think whilst in the short term, there's not a lot of incentive for businesses to consolidate platforms because it's hard work and you've got to do SOAs and all those things are sort of friction points. As more and more evidence emerges that valuations are higher, if you're planning on selling your business the next 5 years, that will happen. I think the real trick is obviously trying to find the right platform to be monogamous as well. Just to prove the point, and thanks to the team Professional Planner for always covering this space with interest. We put that prediction out late last year. I got a lot of heat for it, but lo and behold, that started to manifest. So the team at Investment Trends that actually do the real research certainly indicated that was starting to happen. And it wasn't so much about the number of platforms, I think, necessarily is the key driver. I think it's the share of wallet. So it's how monogamous are they being? And increasingly what we're seeing here, and the evidence here was 71% of new flows were going into a primary platform, really tells me that businesses are anchoring that way. And there might be just some other strategic or best interest reasons why you might be using another card, potential platform, potentially risk management. And so that's continuing to happen. Our latest data sort of suggests it's closer to 80% now. So we'll watch that one with interest over the next 12 months. Firms, despite that it's painful, firms are indicating to us, so this is our tech health benchmarking survey, firms are indicating to us that they do want to consolidate platforms. I think from a lot of perspectives, when we technology projects with businesses, There is a direct correlation between how successful we can be and just how scattered the data is across the industry. Obviously, businesses that have, in many cases, a dozen data feeds coming into Xplan or whatever their primary CRM is can create real complexity around different advice processes, particularly around the annual reviews. And whilst most data feeds are pretty good, the more you have, the more chance things are going to be going wrong. I think that's what's driving a lot of that. Obviously, there's some commercial reasons too. Businesses are more likely to get a better deal potentially with one platform, but also let's not forget the use of managed accounts, which is obviously very prevalent across the industry now for a bunch of reasons, means that it doesn't make you can't really have your platform loyalty too widely spread if you are trying to get your managed accounts on those platforms. They're going to want a fair share of your wallet to sort of justify putting those investments on. So that is also another reason why we think it's going to keep happening. Who are the winners in the platform space? Look, I always get into trouble because some of the other platform businesses don't like me saying them. Businesses are going well, and it's probably going to hurt me even more this year that Hub owns part of their software business, but they are winning, Hub. And so Hub now own the primary sort of winner when it comes to discretionary fund flows. So discretionary super contributions in the industry, or competitive contributions, I think they call it, Plan for Life, is now Hub24 is one of the leaders. It's actually right up there with some of the big super funds like Australian Super. And so we've seen record numbers of inflows. They just put out some results. They even surprised analysts this week with their first half results for net flows. So, and we'll talk more about what's going to drive some of this longer term, but we are sort of seeing those sort of winners continue to stretch their lead. And I think for a lot of those reasons that I alluded to last year as well. From a share price perspective, obviously that was reflected. Their share price was really strong last year. Probably Netwealth would have had a stronger share price result. They had very strong results as well and issued some good results today actually too. So, which I haven't had time to review, but obviously the Shield Guardian thing was probably the thing that's had an impact on Netwealth share price in the short term. But I think what's been quite interesting to see is that the lead has continued to stretch somewhat. Obviously, businesses like AMP and Signia, CFS, Macquarie are trying to catch up and seem to be catching up quite quickly from a functionality point of view, which is great. But just like any industry, scale is a hard thing to catch up on really, really quickly when you've basically got two providers getting 80% of the net flows of the sector, and we expect that will continue to happen. One of my favourite ones was the accelerated insourcing of advice and tech across industry super. So I know we Finura, full disclosure, we have clients in the not-for-profit sector. And we also have a lot of IFA clients, and I've never quite understood the rivalry, but I do. There's a lot of politics around it. But obviously this was the year, I guess, where even the federal government, who has always been accused of being probably too friendly to industry super, sort of said enough's enough when it comes to poor service. And there were some key triggers that really broke the camel's back when it came to super admin. I think the great tragedy in a lot of this is that superannuation administration, so the outsourced companies that do all the admin for these big super funds, run terrible businesses. And so we saw Link being privatised last year into private equity. Iris rightly sold off their super admin business to Apex. Mercer are now out of that business as well. So as I understand it, in fact, all outsourced administration in Australia, super admin in Australia, is now owned by offshore private equity predominantly. And so it proves to us that it's a scale game. It's not a very good game to be in. And so I think part of this issue was really driven by the fact that the not-for-profit sector drove fees down so low on admin that it was completely unsustainable to provide those services. And now that we have a retiring population, it's little wonder that members are now straining those resources as well. Personally, I feel like it is a bit of a national interest issue that almost all of our not-for-profit superannuation sector has its admin outsourced by offshore companies owned by private equity. I don't think that's a good result. I think the banking sector went that way. There'll be a lot more discussion about it, but the realities are it's a terrible business to be in. Grow, who are a startup incumbent who Hester went to, are now up for sale. They haven't really looks like they've struggled to make it work. So the economics are just not great in this sector as well. Mentioned Grow. I think what's unfortunate, I suppose, is that, even some funds like Hester that had really the right thing and said, we want to go with more innovative technology companies for our administration platforms. That's potentially bitten them in the bum a little bit here, because it's quite likely that Link, who Hester left to, may actually acquire Grow. So it's a little bit like potentially moving in with your ex-wife. So I don't really know how that's going to play out, but this is a collective industry issue that's got to be solved. And as I said, I think at the heart of it is that this relentless focus on low weekly fees has hurt everybody, and price wars don't help anyone in the long run. I mentioned before that we're seeing consolidation in the competitive flow space in the super fund sector. So now is the first time we're seeing some of the not-for-profit funds enter what we call the net outflow stage. They're actually declining in assets because of retirement populations. I think they've underestimated, many of them, just how quickly the money can go out when consumers take matters into their own hands. They go and see independent financial advisors, they set up self-managed super funds, and that's why the likes of Australian Super and others are starting to see outflows at levels they did not anticipate as well. But it's quite obvious that the advised platforms, particularly the leading ones, are absolutely growing faster than the not-for-profit funds at the moment. And I honestly never thought I'd see that in my career, but here we are. Here's one we got wrong. So we've seen a lot of private equity investing in financial advice businesses in the last probably 4 years. There's a number of key players. I think everyone knows who they are. They're not just PE firms. They're also dealer groups who are now investing in the advice businesses. Strategy makes complete sense to me. It's a great part of the value chain to own. And I think it actually has facilitated a lot of succession issues in businesses as well. There is a bit of a common perception that private equity equals big investment. It can do, I suppose. It's patient capital. So you don't necessarily have to, you can think a bit longer term with the way PE firms think. But at the same time, they do have a window, and for many, it's 7 to 10 years max. And so whilst they will make some strategic bets, they're probably less inclined to make huge bets when it comes to tech, particularly if the payback isn't overly attractive in the initial years. So we certainly saw PE firms sort of looking to consolidate a lot of businesses together. So I think what we're seeing is not so much a tech investment, but we're seeing an investment in aggregation of businesses, bolting businesses together, standardizing processes, and then using that scale to then get better value for money on that side as well. But I think we probably overestimated what it would actually mean for the tech players themselves. I don't think it's meant a hell of a lot at the moment because, as all of us know, integrating small businesses is certainly no easy thing to do. Why are we in this space? Obviously, the valuations of licensees as pure business models is probably not as high as what it would be in the advice space, or certainly in the product manufacturing or technology space as well. So we expect to continue to see that advice businesses investing in this area. Yes, they will want to improve operational efficiency, and I'm all for it because it puts skin in the game. It gets the alignment of interest happening as well. That said, a good bounce back in the valuation of the ASX listed companies on the ASX. So we are seeing them sort of started to move out of that real small micro cap space. And so some of the names there have actually had really strong years from a business performance point of view. So there are businesses out there proving that you can be profitable as a licensee, but you certainly need scale to do it. And I think as these businesses continue to grow and aggregate scale, they may start making some more deliberate decisions around tech in the future as well. One we got right, business opportunity here, AI services. We should have eaten our own cooking on this one, Danny, because I don't think Danny expected that 90% of her role we're doing a lot of work on AI with her clients. I think what's been great about it is it hasn't actually been about buying AI or building AI. It's actually helping businesses make decisions that implement AI. AI, like any other technology, requires a lot more change management than people expect. And I think people are truly underestimating just how long that change management process is actually going to take with a technology like AI that just works differently from anything we've seen before. We've seen estimates from Sequoia that they believe the AI services market in the long term could be a $10 trillion industry, much bigger than software itself. Make no mistake, that's not about spending $10 trillion new dollars. That money is coming from wage labour. So there are a lot of businesses out there that we've spoken to who are building software and their business model and their return on investment assumptions that they pitch to customers is about taking wage labour and making it into an AI service. And we'll talk more about sort of software pricing in a minute, because I think that's going to be a big theme this year. Accenture, probably the only big consulting firm globally, actually had a really good result this year. So broadly, consultants have had a tough year for a whole bunch of reasons. But you can see here that Accenture had a $10 billion year, almost forecasting this year, and just AI services alone, just doing generative AI work projects for their clients. I think they'll continue to lead the way on that front. So that certainly tells us that this is a good sector to be in over the long run. We love this one. Marketing tech. There is a term out there I was told by Simon and my team called MarTech I'm supposed to use for things like marketing technology. But the two clear winners this year were absolutely podcasts and YouTube. And I just want to unpack a couple of key things where I think it's really important. YouTube's now the number one streaming platform in the world. So more people watch YouTube than Netflix or from Disney or Paramount or any of the other sort of tools that you use, KO, whatever it looks like. And if my kids are anything to go by, that's absolutely true. We're seeing some really scary data, actually, just how much time kids are spending on YouTube. And I've had to really try and manage at home. I think the social media ban is going to help us a bit with that. But like it or not, YouTube's now the world's biggest media company. In fact, if it was actually listed on as a separate company outside of Google, it would still probably be one of the top 100 companies in the world. So it's a juggernaut, and that's just going to continue to grow because of the way they serve up content. Their algorithms are so good. Podcasts, I still think one of the great untapped market opportunities. I'm still really surprised by how few advice businesses advertise on podcasts. Now, maybe they just don't advertise on the ones that I listen to, but Spotify has some amazing ad technology now that you can actually do a lot of direct targeting to that. I did recommend advisors to advertise on the Rest is History podcast. It's a favorite of Danny and I. It's now become one of the world's most, what's the top 10, one of the top 10 podcasts in the world now. 11 million listens every episode, apparently, is their average. And I think a lot of people have missed a great opportunity to advertise to a very good demographic who love listening to long form history podcasts, because I can imagine it ain't so cheap anymore to advertise on that as well. I wanted to talk about some advisors that are nailing it. So shout out to one of our clients, Waddle Partners, Drew Meredith here. They have been on the podcast content journey for a long, long time, and they absolutely look like pros because they're really, really good at it, but they've invested heavily. I just want to call out some of their stats. So they have nearly 17,000 subscribers. This is an advice business based in Melbourne. Their average views range from about 100 to 200,000 per episode on YouTube, talking about different types of content. That's incredible for a small business to achieve that. And I'm sure Drew will tell you it didn't happen by accident. It was just the relentless being uncomfortable, being relentless, and working hard at it, and the algorithm rewards you. And that is a business that I'm sure had no shortage of leads to manage. So podcasts can work, YouTube can work. And what we are finding even in our own podcast at Finura, increasing number of our audience are actually moving to YouTube to watch the podcast. So don't just do your podcast on Spotify, also look to launch it on YouTube and make sure you have video content as well. And there's a whole bunch of reasons with AI that you want to do that too. The tech of the year was definitely AI agents. So that was a big part of the work we did with Microsoft Copilot. So Finura's done a lot of work with Microsoft Copilot with its clients. I know a lot of businesses that have done some great stuff with Salesforce using their agentic capability as well. When I say agents, we're not talking about bots. We're just talking about a little bit of generative AI, building a bit of workflow. And I think one of the great things that AI has offered is that processes like building what would used to be called, people use threads and workflows. Used to be quite challenging to do, but now you can actually use natural language and actually build out a lot of workflows inside those things. Not seeing that in the contemporary, in the advice CRMs at the moment, but certainly in the global CRMs, HubSpot, Zoho, Salesforce, Dynamics are improving that agentic capability. I hope to see that more in the local advice tech space, but I think there's potentially some challenges as to why they can't do that right now as well. This tracks spending on AI by businesses. So this is credit card data from the US, probably a good proxy for our market. So, obviously through the year, we saw a real acceleration in the amount of spending on AI across businesses. This is sort of subscriptions. Word of advice here, we've still come across a lot of businesses that are not checking all their subscriptions, and we fall guilty of this as well. So really good exercise. A lot of these companies are really good at renewals, so they just don't often tell you when a renewal's happening or the trial's ended and you're paying as well. So that's probably driving a little bit as well. What we're really curious to see is probably the data in a year or two's time. How much does it stay at that level, and how sticky are these AI solutions for these software companies? Are people just onboarding it, using it for a little bit and then dropping off? Or can they create stickiness and loyalty in their systems as well? But our anecdotal feedback is we are seeing quite high levels of churn, which is a term we use for people who come on and come off of software quite quickly, particularly in the AI space. Our data on AI usage across the market, pretty widespread. We see Microsoft Copilot as a real sort of mainstay that people are tending to use because they've obviously been well advised that it's a safe place to use AI. But over time, we are seeing this has grown over a period of time, and now starting to see a lot more businesses use other large language model providers like Google Gemini, which has improved so much. I'm going to talk about Claude a little bit later as well, and even just OpenAI directly. And you can see in the top, those sort of small ones are more those industry-specific AI tools, which predominantly fall into the, I would describe as the file note taking type sector, but businesses are in many cases now using 2 or 3 bits of AI. There's a whole bunch of risk management stuff that you got to consider, and I certainly advocate people doing our AI health check to make sure you're keeping your data safe. So that was 2025. Let's talk about this year. And I actually think this has been one of the hardest years to predict because there's a lot of geopolitical uncertainty. There's a lot of uncertainty with AI itself and technology. So what we really try to do as predictions is just stay really focused on what we can see and control in this industry and what just sounds right and feels right. And we look at a lot of factors that to sort of influence these decisions, but a lot of it's just underpinned by data. But often you can learn a lot from the past, and trends tell us a lot of story. Quick disclosure, the 2016 trend took off on Instagram. I thought I'd show this. This is my 2016 photo. This was pre-getting married, pre-having children, pre-starting a business, pre-getting a big mortgage. So the baby face is there. So a lot can happen in 10 years, I would say. But it feels like with AI and everything that's happened in the last year or two is that nothing happened for a long time and then everything happened really, really quickly is how I feel. But there's the 2016 trend for me. So what everything's going to happen this year? I want to start with probably the most important one, I think, is the AI governance reckoning. Like all technologies, it moves faster than what our regs and our professional standards can keep up with. Technology is just more nimble. We are still dealing with a federal government that hasn't got its head around crypto. To give you an example like that, AI is absolutely no different. We are not in a position, I think, where we can even wait for a government to regulate us on how we should or shouldn't be using AI. The tech just moves too fast. So I personally and Finura were a big proponent of a sort of self-regulation. So this is something that I think every AFSL, every business, and just from a legal, ethical perspective, has to make its own decisions on how it wants to regulate and use AI for different reasons. And there's 2 key issues to consider. What am I comfortable with as a business and how I use AI, and what risk am I happy to take there, and what level of risk am I happy to take on behalf of my clients? And I think there's a big gap between the two because you'll have a wide range of clients with really, I believe, really differing opinions on AI at the moment. And a lot of conversations over the summer break with my in-laws validate that as well. We've absolutely seen people overestimating their skills and ability with AI and also their belief in AI. So what I mean by that is that because of the nature of AI models that they tend to want to please us unless they tell us to, unless we tell them not to please us, particularly people using those general large language models, they get quite infatuated or fall quite in love with how nice it is to them as well. And we saw a lot of peak amount stupid behavior, often by quite senior people in organizations in the last 12 months who really were quite ill-informed and jumped to massive conclusions about what they thought AI could do for them and just assuming that everything AI gave them was right. I think you need a lot of people in your business to validate AI outputs. I was talking to a very large licensee yesterday actually about that very issue. We were sort of working out, well, could you save a lot of money in compliance with AI? And she made an excellent point. Well, actually, we're probably just going to have to use those people to validate a lot of AI outputs in the future with human in the loop. So this Dunning-Kruger effect is really taking effect. I think we feel we're out of that sort of valley of despair to a certain extent with AI. I'm feeling a bit more optimistic about it, but I rest assured we saw some really strange behaviour last year by advice businesses and advisors and how they were using AI. Obviously, the amount of apps we've got to deal with is a real challenge. So, and what I would say is that, you know, the barriers to entry to build an AI application are just so low. So our software developers last night, in a few hours, spun up an AI fine-tuning prototype just because I asked them to do it. How long would it take? And they used another platform to do it. And they pretty much have a functioning prototype now. So a lot of those AI fine-tuning tools you built can be copied quite quickly. The main things they do lack, and this is why AI is a bit of a risk, I suppose, is that a lot of them do lack access to data. And there's a whole reason for that. A lot of the data inputs they're getting are from your client meetings or other documents that you feed it, but they're not necessarily taking the data from what we would call a trusted, reliable system of record because they don't integrate necessarily with everything. Now, that will change, without a doubt. That will change. But the reality is that because it is so easy now to stand up a software business and so cheap to build simple applications using AI. We're just going to see more and more of these happening all the time. Make no mistake, a lot of these businesses, not all, but a lot of the businesses, particularly ones from offshore, are here for a good time, not a long time. So they know there's a window. They know there's probably a 2-year window to win a lot of market share, grow a business, sell it, get out, sell the rest to private equity. That is absolutely playing out in the AI space at the moment. What's driving some of the things we're seeing at the moment? So starting to get increasing evidence of businesses that were initially just doing AI note-taking, which I think is an awesome use case to solve because it's given advisors so many hours back and arguably does a better job than taking human notes. They're starting to now move across different areas of the advice process. And I understand why they're doing it, because there's so much intense competition between them. They would all disagree, I'm sure, but there is not a lot of differentiation between the job to be done that all of them do. They do things in different ways, and there's different things they might offer, but they all work fundamentally on the same underlying large language models. So that they're really just using that tech for that use case. So that makes it hard to differentiate. So what you are finding, and you will find in 2026, is these businesses will start doing more jobs. So they'll start generating SOAs, for example. Starting to hear a bit of noise about that. Start looking at, can they be agentic workflows inside your practices? Can they start extracting data for fact-finding purposes? Can they be bots direct to your client as well? And so they're going to try a whole bunch of things to, firstly, maintain the customer relationship, which makes complete sense. Secondly, to differentiate, because that's a hard thing to do. But the third one is to try and entrench you longer term to keep your data there. And the reason they've got this opportunity is that the businesses on the top of the line there, who I'd say are more, not all, but most of them are sort of the incumbent advice tech providers, have not rolled out a lot of AI at all at this stage. That would be, in a similar vein. So a lot of them have done little bits of AI here and there, but because these are organizations that are enterprises, they're going to be really safe with data, particularly like, I would say, those three on the left who are owned by really large corporations, they've got to be bloody sure that what they're doing with AI is absolutely safe and usable from a CRM perspective. I strongly believe that's going to change this year, though. I think they will start incorporating more AI features in their products that will probably maybe reduce the opportunity for these more AI first products to take that part of the value chain. I don't necessarily how it's going to play out. I think the AI first software platforms that are prevalent now coming out may work really, really well for small businesses. I think small operators are actually going to love those capabilities if they can do it. But still, we have some concerns potentially about what are the unintended consequences. So at the core, AI is probabilistic. So we can put the same inputs into an AI workflow, and quite often we'll get different outcomes depending on how we put those inputs in. And often it's hard to backtrack and recreate those things if something went wrong. And I think in the hands of untrained people, it could just take us in directions that we maybe wouldn't expect. So I guess our word of caution for the industry at this point is that we've just been given this tech with AI. It's quite new. We've got a long way to go. Maybe we'd be a little cautious about throwing it at, I would say, very high risk activities as professionals that maybe we wouldn't want to necessarily be on the stand blaming an AI LLM or an AI software company for something that goes wrong. We've already seen this happen in other industries. So in both the US and now in Australia, we've seen lawyers recommended for disciplinary hearings for submitting AI hallucinated documents. There was the well-publicised case by one of the large consulting firms submitting a very large government report to the federal government, charging a lot of money, and turned out a lot of the references were generated by AI and hallucinated. And in the US, we're starting to see some really concerning things happen in the medical field as well, where things have been recommended to patients that weren't appropriate, and so and particularly in the insurance space as well. So it's not until it starts costing people money that people understand some of the risk here as well. So we have a strong view, and our prediction this year is there will be some AI enforcement activity. We believe there will be some AI missteps that will be public for our advice industry in some way, shape, or form this year. And the regulator is going to come down really, really hard. Prediction number 2, platform oligopoly will drive new ecosystems. So this really stems a little bit from last year about platform monogamy, is that we are seeing a rapid consolidation of market power into a couple of platforms predominantly. And this is really common in a lot of industries. So a lot of industries over the years do go through this process where they have lots and lots of lots of scattered competitors across different markets. And over time, the scale grows for a whole bunch of reasons. The amount of competition shrinks because simply one or two players start aggregating all the market power. That is certainly potentially starting to happen from a platform perspective. And it's just a bit self-fulfilling because all of a sudden you become the main platform everyone uses. There's some network effects. Everyone knows it. Everyone trains it. People are more likely to acquire your business if you're using that platform. There's a whole bunch of reasons why these things happen in markets. And it's not necessarily bad for the other competitors. It just means that they have to potentially choose different strategies, or they just end up being merged or acquired to compete, is what happens as well. And this has been happening since the dawn of capitalism, and certainly shouldn't be a surprise to anyone in our sector. The conventional wisdom by many economists is there's a rule of three. In any real market, there's sort of two major leaders in terms of what they do that are hotly competing with each other in any particular space. And I've obviously just picked a couple here, the airline manufacturers, I should say, the credit card payments companies, and I've got the major phone manufacturers here. But there's still room for a third in most cases. And what you typically find is the third player is a little more innovative because they've got more to, they're having to fight to compete to keep the other two honest. And so in companies, the one you probably don't know there is Comac. That's a Chinese aircraft manufacturer, but believe it or not, can actually build just as good aircraft as Boeing, surprise, surprise, at a cheaper price as well. And so whilst it's not as well-known brand and name, it can actually do things a lot better. Samsung, well-known for innovating, first out with the foldable phone. Turns out Apple's going to do a foldable phone this year. So they tend to be the ones that innovate a little bit fastest. We believe in the platform market. What's less clear at the moment, I think we all know who the two leaders are. I think what's less clear is who's going to command that sort of third, fourth spot, maybe from an innovative perspective. It could be one of the incumbents that's got lots of scale and was bank owned prior and who just finds a way to really get it going again. Or it could be someone who's up and coming and emerging who we just don't know of, and offshore as well. And that's an interesting place. The platform market share, really obvious here. So we're seeing nearly close to 89 going to those two major platforms as well. That's going to drive a lot of this scale. What's the consequences, I guess, of two major players becoming so dominant, I suppose, over time? Firstly, less likely to have a price war. It's not in anyone's interest when there's a duopoly or oligopoly to create a price war. That's probably the first thing. So I know many people have predicted the platform fees will drop a lot. I'm less confident of that. I actually think, at least in the short term, it's in everyone's interest to keep platform fees kind of where they are, unless a real disruptor comes in. But the second thing is then, how do you command loyalty? How do you sort of make people want to stay with you for the long run? And so I always love the case of Apple because they sort of did it in a really interesting way over a period of time by creating an ecosystem that just meant ideally you want to love to stay, but you also think about your switching costs of leaving and go, you know what, this is all too hard. I know so many people who occasionally look at, when I had a folding phone, look at my folding phone, a bit of envy and go, I'd love to have one of those, but they just can't fathom getting rid of their AirPods, their Apple Watch, their iPhone, their Mac. It just wouldn't work. It doesn't work with that. So Apple has sort of done this wonderful job of building an amazing business by creating an ecosystem. We believe the opportunity is there for the major platforms to do that as well. And Netwealth have already, sort of lent into that somewhat, because the reality is that our industry continues to be starved of capital. So we don't have anyone really there to build big ecosystems of tech services for our industry. And I've heard many times people are actually saying, well, I'm kind of expecting the platforms to do it because they've got all the money. How are they going to do it? So we believe when you look at all the things that an advice business needs to run, so technology, data, other applications, community, education, good products and compliance and governance, and then soon AI, platforms have a lot of that capability now already. And so what we do expect, and certainly Hub were quite public about this late last year, is that we will expect those businesses to start investing more in this sort of ecosystem. So basically two things. One is to provide more valuable service and sort of retain their customers for the long term. And I think too, objectively, potentially shut some other competitors out that might emerge who can come in at a much lower price point potentially and disrupt the market. There are a lot of better phones out there than an iPhone, believe it or not, but people don't buy them because they just don't really work with anything, is the reality. So this is a proven strategy, and we believe strongly that this is actually what's going to take place over the next couple of years. Digital advice. We always have a prediction about digital advice. We're in this space. We've done a lot of work with super funds. And whilst we have seen a lot of activity in this space because digital advice drives farmer retention. So now that farmer retention for super funds is really an issue, super funds are now waking up to the fact that, hey, advice just isn't good for members. It's actually really good for them too. It actually retains money on platform. But we have a problem, is that we might be great at selling products as an industry, but I would argue that the product manufacturing, and particularly the sort of not-for-profit superannuation sector, has no experience selling advice. There's probably one fund that's done it really well. And so the reality is that we as an industry do not command the attention of our customers or members terribly well. So this data is from ASFA, and they still find that over, for the last decade I've been tracking this data, the majority of people still sort of access either a professional advisor if they can afford it like that, or they'll find a human advisor through their super fund. You see here from this data, so track those black lines if they're older, friends and family. And only sort of the end will they look at online resources. So this is in some ways a bit of a generational issue. The thing that kind of made me curious was that even the 18 to 34 sector are not using the online calculators and tools that have been built out by super funds over the last 5 years. They are still going to friends and family for financial advice. I think they're going to one other place as well. Aussies are overwhelmed. If you have to log on to any system, whether it's your banking application or heaven help you, your MyGov, we are terrible as a country at building digital solutions for a whole bunch of reasons. And a national ID is a big part of that problem. This is all the data that a person has to put into MyGov to operate within that framework. Boston Consulting Group did a really big report. I'm not going to pay much heed because it was all words, but they identified some of the issues that any of you have had experience using MyGov would actually be finding as well. If we are building solutions that create a lot of friction, confusion, and overwhelm like MyGov, there's a very good chance that they're not going to engage with it. And that's what we're seeing. Engagement with MyGov in Australia is appallingly low compared to other markets. The country I'd encourage you to look at if you've got some free time is Estonia. They now have 98% of their citizens using their digital platforms to do everything digitally like that as well. I believe that is the secret sauce to getting digital advice to people more effectively. We have to build national infrastructure that makes people more comfortable to go and do things online. We're just not there yet in Australia. The other thing is how we interface. I know a lot of funds have built calculators and they all look great, and I know the usage may seem quite high, but I would argue that the usage is only high in absolute terms. I think in relative terms to our population, member sizes, number of people we see retiring, I think that's appallingly low personally. And the main reason is that these interfaces in many cases are overwhelming for the average person. They do not want to use them. We are now predisposed to use simple, clear interfaces like this one, or now this one. And so my aha moment, my mother-in-law, who is quite anti-technology, she was telling me how good ChatGPT was for her the other day, helping her plan a holiday in Greece. It's only a matter of time, but she starts asking that other questions about her money potentially as well. I'm not so sure this is where we want to be, that we have, that we give the game away to these AI models. But I can tell you there's a real risk it starts to happen. Once the older generation start using ChatGPT more and more every day, they start to trust it, and they will inevitably go for financial advice. US data suggests that financial advice is about number 2 or 3 on why people are using ChatGPT. Number 1 is for counselling, life counselling, mental health, relationship advice. Number 2, medical advice. And number 3 is for actually financial advice. So this is our competition now. And I think we will find, my prediction is that we move away from these calculators and we start moving more to chat interfaces, because that's just what people are going to get used to. Bit of a shout out to the guys at the TiVo here. It's not well known, but if you're a user of their platform, they have a functionality called Ask a TiVo. So it's still beta and they're doing a lot of work on this. I think this is really quite interesting. So this is actually, I have an account. You can go on and get an account really easily. You can ask it a whole heap of questions like a ChatGPT, and it provides a really safe way to give a member guidance in an interface that they will be more familiar with, perhaps, than online calculator driving sliders, moving them everywhere. I think there's 2 elements here. I think this provides optionality for businesses to deal with people with obviously different disabilities, different languages, and also people who are just maybe not that financially literate in the first place. We can use AI for this reason in chat interfaces. So the prediction really here is that digital advice will suit people that are already digitally engaged. I think the real future is creating chat interfaces that is just going to be the way people will engage with software and their tools moving forward. The reason why there's a difference between why I think we can't market advice too well is, remember the Waddle Partners YouTube channel, they're 17,000 subscribers. I don't want to pick on Australian Super, but they probably don't care what I think. They've got 3,000 subscribers. So Waddle Partner might be getting 100,000 views on their videos. Australian Super is lucky to get a few hundred. So this is our largest fund in Australia, and it can't put out content that's getting its audience to use. We are making some massive, massive assumptions in this country that if we think that super funds are the only way to get advice out of people, and I think we need a more collective and a more technology forward approach. Licensee services, this is not necessarily a tech prediction, but we feel that licensee services business model is a little stretched and there's a new competitor emerging. So whilst I mentioned that the licensee market's now worth $319 million from a market cap perspective, which is great, good, stable, strong businesses here, there's now a bigger market which is playing out, which is the managed account market. So we estimate that market's worth about $3.2 billion. It's probably going to double in the next few years. That's probably a conservative assessment. Managed account businesses are valued very highly, and the recent Evidentia acquisition by Generation Group was evidence of that. So this is a really good place to be if you're successful and wanting to grow a really big business. Obviously, it's a business that's based on loyalty, and managed account providers are looking for ways to create new service models, stickiness, and differentiation. Potentially even more so if we run into bumpy investment markets, those relationships could get a little tenuous. So we really only had this managed account market in really bull equity conditions. I'm really curious to see what happens with managed account providers when they're a bit more on the defense and not looking to protect IFA relationships. We are seeing managed account providers already starting to acquire more capability in the practice management space. So this is definitely more targeted to the IFA market, but there are a whole bunch of services businesses out there that do provide, I would call it licensee or IFA small practice services. Managed accounts businesses are going to come into this space really, really hard, we feel. Obviously, Lonsec was the first one to do it, buying the Encore guys, probably one of the best known consulting businesses out there. So it's been great for them. But you can sort of understand why they want to do it. They want to build capability. And I've also seen other businesses, so Drummond, Ascalon, and BetaShares, all hiring what we would call practice development, practice growth roles. And it makes sense because guess what? The managed account provider wins if the practice is growing really strongly. So the interests are really aligned, but they don't wear that compliance hat necessarily that they have to wear, that the dealer groups have to wear. So I think it's going to become a really interesting dynamic for our sector. The other point I would say is that these managed account providers have the capital. They're going to get a lot of investment because it is such a good place to be, to invest more and more in this capability. So we would predict that managed account providers will either start building more of their organic practice development capability or start acquiring it. I would not even be surprised to see a managed account provider acquire a dealer-to-dealer services business in the next 12 months. And the final area that could make it really hard potentially for traditional licensee services models is ASIC really digs its heel in on how we manage conflicts at the AFSL level on managed accounts. Not in my wheelhouse to talk about, but I feel this is really going to be a hot space this year. Wrapping around to the tail end, this is probably the least favourite prediction, I think. Expect a big price bump in your software in the next couple of years. I hear a lot of complaints about how expensive software is, but I just need to pass on some messages on behalf of some of the software companies who may be dialing in today. We in Australia don't pay a lot for our software by global standards. And so I'm aware whenever a software company puts their prices up, I get a lot of emails about it. Did you hear about this? And I see a number and it might be 6, 7, 8%, something like that. And you go, gee, yeah, that is a big hit. I kind of get it. But compared to two things, inflation and compared to what we see in enterprise software globally, those single digit increases are actually quite modest compared to what we've seen in other markets and other industries. It's probably my first message as well. I do think for the software companies, if you're going to put your prices up, do it before the end of the financial year so that businesses can forecast and budget for it. I just think businesses get really pissed off when it happens midway through the year and no one's expecting it. That's, anyway, a bit of friendly advice. But what we saw last year was the highest sort of numbers were about 7%, Wealth Tech. There was one or two providers that did a little bit more than that, but I don't want to hit them hard because some of them didn't put out their fees for 4 or 5 years prior. They just hit a breaking point. There are a lot of input costs that are killing software businesses at the moment, and those fees have to go up. Sure, if our market was growing, sure, if we had double the number of advisors, and sure, if we had lots of banks spending shit tons of money investing in tech, maybe that wouldn't be such a big issue. I think businesses just have to start thinking a little bit differently about how these software costs are going to come through. Spend per employee. I'm trying to get some data from our clients on this. We see in the US that sort of average spend on software per employee in a professional services business about $13,500. I've converted that to Aussie dollars just for clarity. So that's a number. This is where we sit as an industry, about 5,000 per employee. It's pretty low. So I just think it's only a matter of time before we just have to get used to price increases on our software. Yes, you should hold your software vendors to account, but I want to change. I think you change the paradigm. And I think what it's about is actually ensuring that the people in your business who are fundamentally will always be more expensive than the software that you use, have the tools they need to do to be super, super efficient. Change the mindset. There will be lots of new AI players coming to this market. We've already seen Marlu come in and a few others in the AI space. We've had a lot of inquiries in the last 6 months from AI providers looking to us to consult now about whether this is a good market to come into. We haven't engaged any of them just for disclosure, but this is going to happen, particularly from the UK providers who I think are going to run out of market pretty quickly for people to sell to. Lots of new AI tools coming in. Business owners are still overestimating what AI can do for them. That's never going to change, but the AI usage is really high in Australia. It is actually higher than a lot of other markets, so that's going to happen. Some hot tips. You're going to get smashed with advertising. It's happening to me. I'm getting those AI tools advertising to me. It's becoming a bit overwhelming, actually. So, and look, fun fact, in most cases, if they've raised capital, and if you always talk about how proudly how much money they've raised, half of that tends to go on sales and marketing. So that's what's paying for all the advertising. I did have a couple of advisors comment on some AI providers who were at a conference recently, and there was a cast of thousands there, how they're affording this. That's where it comes from. They spend all their money on marketing, typically not necessarily product development. I think consumer LLMs are going to change. OpenAI is going to release its first hardware device this year. Here's Johnny Ive, the iPhone designer, an Apple designer with Steve Jobs. They used to have lunch every day. Here's Johnny with Tim Cook when they ran out of ideas and just thought that different color phones were good. Here's Johnny now with Sam Altman, who's the polarizing founder or sort of CEO, I should say, of OpenAI. Sam Altman acquired Johnny Ive's business for some strange reason for $6 billion. They are going to be building a bit of hardware, a device they're going to sell to us all. Lots of rumors about what it's going to look like. It will be it's going to be a screenless recording device, is all we know. So there's some ideas there of what it could be. Why am I telling you this? Firstly, your staff are going to have it. Clients are going to have it. And there's going to be an inevitable ubiquity and challenge of AI in the workplace. The final thing too is that Siri is going to get good. So in simple terms, Siri's done a deal with Google. Google Gemini is an amazing AI model. I think Apple phones are going to get incredible this year, and that's going to change how people engage AI as well. Technology of the year. We've gone with Claude. So we use Claude at Finura. It is a more enterprise business focused LLM than OpenAI in our humble opinion. Still things to work through, but Claude are deliberately leaning into the enterprise. They are catching up with OpenAI, particularly on the enterprise space. They are a provider of really good technology, both large language models, but also chat interfaces and tools. They have built an ecosystem for financial services. I would expect Claude to start doing a deal potential with some of the major platforms I was talking about here in Australia to be able to access that data really safely. If this happens, this will kill a lot of AI startups in Australia because Claude can do out of the box what these claim to do. And once we have data pumping through these systems really securely, a complete game over. So they built it on trust. Dario, the CEO, well known for being a sort of probably the safer, more measured CEO, and has really played that card really well. Whether that's true or not so sure. Why do I think that's important? Amazon's actually the biggest shareholder. Amazon provides cloud computing services to a third of all software companies in the world, including us. And so a lot of the capability with Claude we could use in our software, which is really exciting. So I think this is what is going to drive a lot. And we think more businesses will be using Claude. They have built a Copilot competitor that's launched this week. I'm just going to play. I've got access to it. So I'm going to play with it tomorrow night. I have a feeling it's the Copilot we always wanted. And so if Microsoft copies this, that'd be great because Claude has a usability that we really like. So that's our tip for Tech of the Year. There's our predictions. I've only got 3 minutes left. I do want to wrap on a few key things to talk about. So just a little bit of a plug for Finura. We put a lot of content out there. We really promote ourselves, but Really encourage you to listen to our podcast. We're now featuring some clients. So if you're ever curious about what it's like to work with us or our team, we've got one with Corey there from Netwealth. Danny also just recorded one with Simon Backman from Wallstrom recently as well. So we're going to feature more clients. And so it's always great to hear their story. And if not that, just a lot of mindless banter between myself and Danny on various issues. My newsletter, I get a lot of great feedback. Thank you. I put a lot of time into writing that newsletter every week. It is not AI, as you probably know, but I have well over 400 subscribers to that newsletter now. So we'll send some details in the chat of how you can get access to that. A Tech Health Check. Please do the Tech Health Check. You get lots of great insights. If you're not ready to be a Finura client, but you do want a bit of a steer on what you need to be focused on for the business, please do that. And the new one's the AI Health Check. I really implore, if you're using AI and you're a business owner or a responsible manager, do that AI Health Check. I tip the fact you can't answer a couple of questions probably tells you everything you need to know about what you need to start researching for your AI governance. Little product plug here. Our advice is on a product. Thanks to everyone who's been using that product. It's an advice generation, obviously, platform that replaces Xplan Wizards for people. So people are looking for more digital advice experiences, digital presentations. Have been adopting it with gusto. Still adopting our first 50 practices, which has been great. Lots of great user feedback. Now having Hub as a shareholder has meant we're now investing heavily in the platform. And so next month we will be releasing our client review module, actually, which is quite exciting. So that's going to give access to all of the platform portfolio data you get next plan. You'll be able to build beautiful presentations on and beautiful review documents. So really excited to see that come out, and any of our existing advices on it, because customers will get access to that for the first 6 months as well. So that's it from me. I've nailed it. I've got 30 seconds to go. So I wish you all a really prosperous 2026. This is a great industry to be in. Let's not take ourselves too seriously, though. Let's stay safe from an AI perspective. Measure twice, cut once. And if you're ever in doubt, please reach out to one of our team, hello@finuragroup.com, or any of the team there that you may know if the industry. Just reach out to us on LinkedIn, and we'd love to have a chat. Thank you, everyone, and I'll talk to you soon.